What is up, Dingoos? Today I have a very exciting video. We're going to be discussing the best trading strategy known to man, and you think I'm exaggerating, but I promise you I'm not. This trading strategy has proven time and time again, because all these wealthy investors like Warren Buffett, Ray Dalio, Pomp, all of these, Angelo BTC, all of them use this strategy in one form of it or another. I promise you, and we'll talk about that here shortly, so make sure you stay tuned. Another thing and another emphasis point I want to point out today is the difference between gambling and investing, because a lot of new people are entering the crypto ecosystem, crypto industry, and the crypto markets in general, and a lot of people are unfortunately going to get scammed by these gurus that say, hey, here we go, there's day trading courses, there's this one indicator that predicts the future, right? And you have to buy and go through paywalls, X, Y, and Z, and then you get there and you lose all your money day trading, right? And I want to point out that day trading is closer to gambling than it is to investing. And here at Dingo's Crypto, we talk about investing, and what I'm about to show you is the best investing strategy and the best way to enter the market and exit the market, right? And let's jump right into it. First, we're going to talk about the Dunning-Kroger Effect 101. And what is the Dunning-Kroger Effect? In a year when the market have minted many new self-proclaimed geniuses, it is worth remembering the Dunning-Kroger Effect. And even if you are a day trader and semi-successful or successful, it is worth noting what the Dunning-Kroger Effect is. So what exactly is it? The cognitive bias, which is the Dunning-Kroger effect, was first identified by psychologists David Dunning and Justin Kroger in 1999. The paper, entitled Unskilled and Unaware of It, summarized, people tend to hold overly favorable views of their abilities in many social and intellectual domains. And what intellectual domain are we discussing today? And that is investing. As the saying goes, everyone is a genius in a bull market. When markets are ripping and your portfolio seems to grow by the day, many fall victim to the Dunning-Kroger effect. We may wrongly attribute this performance to our innate talent as investors. So no matter what kind of investor you are, or if you're a day trader, this might be a good thing to note, and know that you have a cognitive bias when you are entering the market and believing that your abilities are actually more than they are, right? So understand that bias when you go into anything in life, and go in there cautious, as well as with your ears open and listening and finding out the people that have been there a while, and also finding out the people that talk a lot of baloney and bullshit, right? And hopefully you can hopefully see that I'm not full of bullshit usually. Sometimes I bullshit here and there, right? But for the most part, I try to be honest with you guys. If you have any discussion points you want to talk about, feel free to comment. I will get back to them, and we have a good discussion in the comments, because it's always good to have different ideas, right? But let's get back to this, and let's talk about lemon juice, right? And why are we talking about lemon juice? Because the two men that studied the Dunning-Kroger effect had studied the bizarre case of MacArthur Wheeler. And you better not be MacArthur Wheeler, because I'm going to talk about what he just did. So, a 5'6", 270-pound bank robber who was swiftly caught after robbing two banks in broad daylight. He hadn't worn a mask. Instead, he put lemon juice on his face, believing it would make him invisible to cameras. So let's talk about why he put lemon juice on his face. Wheeler was aware that lemon juice was used in invisible ink, so incorrectly inferred that it could be used to make himself invisible to cameras, guys. And how does this apply to trading, and day trading specifically? Because a lot of people come into this market with an indicator that can predict the future, that will give you a green dot right before the market booms, and gives you a red dot right before it busts, right? But I promise you, and I guarantee that no combination of indicators, no single or combination of indicators, will predict the future price action of any commodity, security, X, Y, and Z. I promise you that, and I can prove that it can't, because nothing in the world can predict the future price action of anything. So keep that in mind, and please don't drink the lemon juice. No, don't fall for lemon juice, right? That's the point of this. Don't put lemon juice on your face. And now let's talk about the investing strategy, the trading strategy that has been proven time and time again, and every rich investor in history used this to some degree, and that is risk-adjusted dollar cost averaging. And what is dollar cost averaging if you don't know? Dollar cost averaging is basically taking, say you want to invest $10,000. Instead of doing that in one lump sum, you break it up in smaller pieces. So maybe do $1,000 a month for 10 months, or $250 a week for 10 months, right? And that is dollar cost averaging, and that is a very, very good way to enter the market, in my opinion. And even a better way is risk adjusting that dollar cost averaging. And what exactly is that? So basically you make a risk profile from 0 to 1, 0.1, 0.2, etc., etc., etc. And as the risk of the price goes up, so does your risk profile, right? And it's calculated by the moving averages, and I'll show you that in a second. But when the risk of the price is low, you dollar cost average in more. So say the risk is 0.1, you invest $1,000. The risk is 0.2, you invest 900, 0.3, 600, whatever. You make this up on your own, and then after it crosses 0.5, that's when you start dollar cost averaging out of the market, guys. This is how you take profits, is dollar cost averaging, risk adjusted dollar cost averaging out of the market. So after 0.5, the 0.6 you take a little bit, 0.7 you sell a little bit more, 0.8 you sell a little bit more, 0.9 you sell a little bit more. At 1 you probably sell most of your holdings, if not all of it, right? And that is how you successfully trade. But one key factor in this is doing and investing. This is investing. This is over the course of maybe 6 months to a year, right? And another good thing about this is taxes, long-term versus short-term, right? Over a year is long-term, and that's less taxes. So one thing that is very important with this strategy is to invest in a project, protocol, token, etc., that you believe in, right? You have to believe in a project that has the fundamentals to and the intrinsic value to grow in the future. And let's talk about Bitcoin, because this is obviously probably the main crypto, and obviously will have value in the future and intrinsic value. So unfortunately, Benjamin Cohen, I gotta give him a shout out because I used his videos, and he is a very good mid to long-term technical analysis and data scientist. Go shoot him a follow. Obviously, he has a lot more than I do, but hey, give him a couple more, you know. And now let's talk about Bitcoin USD, because unfortunately, those risk-adjusted charts are behind his paywall, which, I mean, he made them, so he deserves to get paid for them. But an easier way is just to look at the 20-week moving average as well as the 200-week moving average. When we are around these, it's a pretty safe bet to start dollar cost averaging in. Right now, we are a little extended over the 20-week moving average, so I'm sure Benjamin Cohen is taking risk-adjusted, selling dollar cost averaging out of the market right now. I'm sure he is, because it is definitely over 0.5 risk level right now. It most certainly is. It's probably at 0.6 or 0.7, right? So he's taking profits, and this is the trade. He's been a dollar cost averaging, right? Risk-adjusted and dollar cost averaging throughout the last 2 years, and now he's taking profits. And that is how you trade. That is how you become wealthy. And you can do the same thing with Ethereum. It's basically risk-adjusting, dollar cost averaging around the 200-week moving average, 20-week moving average, and the 200-week moving average. So keep that in mind, guys. And that's how you do a successful trade. And if you want to do this with altcoins, which you definitely can, and get a project that you like Chainlink and Polkadot, Uniswap, Aave, Maker, Yearn Finance, Kusama, all these are very good projects, guys. And when it's around the 20-week moving average, start dollar cost averaging in. And one thing I don't want you guys to be like is Wall Street Bets. I mean, I love Wall Street Bets and I love reading their posts, but learn from their mistakes instead of being their top post on their page, right? Don't become the top post. That's the goal. But now let's go into successful crypto traders, because there are some. And the most prominent is Angelo BTC. He has made millions from this exact trade, this risk-adjusted dollar cost averaging. The only difference is he most certainly used leverage. He used leverage, but he did not day trade. I'm almost positive he did not day trade. He did swing trading, right? And basically, he risk-adjusted dollar cost averaging in with leverage positions, and then over the course of weeks or months, he took profits. That's how he did it, and he used the same strategy. This strategy can work in a lot of different scenarios, different lengths of time, and et cetera, but it's not necessarily an indicator. It's just dollar cost averaging into a position. Now let's talk about legendary investor Warren Buffett has suggested the best holding period is forever. Like, you got to listen to Warren Buffett rather than these gurus, including myself. Don't listen to myself. Get other people's opinions, formulate your opinion from these other people's opinions, and go from there. Maybe day trading is profitable for you, and I wish you the best, and hopefully you can be very successful from it. And Kevin O'Leary says, day trading is not investing, day trading is gambling. Nothing wrong with it, and I totally agree with it. If you want to day trade, go ahead, but I believe it's closer to gambling than investing. Nothing wrong with Las Vegas either, but it's not investing. That I totally agree with that, and that's the same perspective that I approach every asset that I purchase. And let's summarize this quickly. So it is not about timing, but instead about time in. Disclaimer, we are not talking about algo bots or arbitrage bots. I love arbitrage. That's one of my favorite things to study. I traded very intensely for 2 years. Looking back, I hated every second of it. I'm talking about myself. I traded for 2 years approximately, and I hated it. Why? Because it was not worth the constant stress and anxiety. I probably aged 20 years. No, I'm just playing, but I was very stressed and had a ton of anxiety every day because of my trades, and it was not worth it. And name one successful day trader, and I will show you 100,000 unsuccessful ones. And even the most successful ones rarely day trade. Like I just showed you with Angelo BTC, he swing trades. And then 1 million. Just imagine this scenario: 1 million people roll a die 1,000 times. Someone is going to roll a 6 1,000 times, and he will think he's a genius, right? So 1 million people roll a die 1,000 times, and one person is going to get a 6 1,000 times in a row, and he will be like, oh, I have an indicator. I have an indicator when to release my die, and it's going to land perfectly on a 6, right? That's kind of what you're doing with these indicators. You kind of just sometimes it's just luck, maybe it works, maybe it doesn't, right? So keep that in mind. Solution: this is the summary right here. Start investing rather than gambling. Risk adjusted dollar cost averaging into and out of the market. Pick a protocol / token that you believe in the long-term potential of, guys. And that sums it up right there, guys. This is the best trading strategy for altcoins, Bitcoin, commodities, specifically commodities, guys. So pick a protocol you like and believe in long term, and wait until it gets around the 20-week moving average or the 200-week moving average. Especially the 200-week moving average would be perfect. Start dollar cost averaging into it heavily based off where the price is, and then hold it until it gets above a certain risk level that you have denominated for yourself. And that is how you create wealth and sustain wealth, guys. And that is all for today. If you think this provided any value for you whatsoever, please shoot a subscribe and like, because I try my best to be honest with you guys and give you an honest point of view. And if you have any gripes whatsoever, comment below and we'll have a good discussion about it, guys. Also, if you want to chit chat more, we got a Discord, Dingooo Crypto, also in the bio. I have my Twitter in my bio and everything else. So if you want to chit chat, go ahead and check it out. And that is all for today. Peace out and dingle dingle. You know it.